It takes us to our talk of the tape. With key earnings and the election in front of these markets, what is the best way to position right now? We will ask Lauren Goodwin of New York Life Investments, back with us here at Post 9. Everybody's trying to figure this out, right? What the best positioning is with yields backing up, the election a couple weeks from today, tech earnings next week. What are you feeling?
Well, I think it's important for investors to keep in mind that underneath all of the risks and changes, we are coming off of a Q3 economy that was way above trend growth. That's a ballast, a support for the equity market that I think can get us through this sort of pre-election time period. So there's no economy problem, and that's really important. As you pointed out, though, our view on risks is that as we get closer to the election, what might be the biggest risk to the equity market is a rates problem. And so expectations that spending, inflation, growth might be higher than the market expects are actually the downside view for the equity market.
So even if rates are going up for the right reason, you think it could be a problem if they get above a certain level? I have some firms today saying, well, look out for 4.5%, maybe even 5%.
Yeah, so on the 10-year, I think 5% is really the go, no-go line when it comes to the equity market. But when I think about the economy, really more of like a Fed funds rate of 4%. So if the Fed's able to cut just a couple more times, I do think that allows for cycle extension, provides a really nice balance between little extra oomph for borrower health, but you still have an investment rate that's attractive for those that are investing. You still have an economy that's chugging along. That's a really nice Goldilocks level. If we get to a policy rate that stops before 4%, that's where I think 2025 starts to look a little more precarious.
Do we need to start planning for a so-called reflation trade, like Paul Tudor Jones told Andrew Ross Sorkin this morning on Squawk Box that he was doing? In the context of that, I want you to listen to what he said PTJ did about one particular trade that he doesn't like. Listen.
I am clearly not going to own any fixed income, and I'm going to be short the back end of fixed income because it's just completely the wrong price.
In other words, plan for the reflation trade. Rates are going to continue to go up in a manner that people didn't expect. So that's what he wouldn't do.
I have an agreement and a disagreement.
Okay.
My agreement is that duration is just not my favorite place to take risk. I agree that rates risk, especially in the long end, is absolutely there, especially when you have a binary event in the election that might drive market expectations one way or another. And what I'm saying specifically is that if you have a sweep in either direction, the likelihood of more government spending, more inflation risk is absolutely there. So we prefer in credit taking shorter duration exposure. And if you want to balance that shorter duration exposure with long duration, take it in the muni curve, which is disinverted. Where I'm not 100% in agreement is to avoid credit altogether. Strong economy, good credit quality across the board, even in the high quality segments of high yield, certainly in the municipal and investment grade markets. You just have very low default risk. And that's not a circumstance where rates volatility, I think, disrupts the medium term return potential.
If I told you that, okay, rates were going to remain elevated and maybe they even creep higher than here, but we know the Fed's cutting rates. Who cares if it's slower and smaller than we once thought? Economy's good. Atlanta GDP 3.4, at least now. And there are a lot of people predicting animal spirits are coming in the M&A market, which has been dormant for a while. Isn't that enough to overcome whatever risks are out there?
It could be very close to enough. Again, I think that it's important that the policy rate moves a little lower from here because it gives borrowers a breath of relief, allows the cycle to extend. But that is an environment where if rates have come off just a little bit, even if they're still, let's say, moderate for a moderate amount of time, that's an environment where historically both credit and equity have performed well in public and private markets. That's an incredibly constructive view for the markets moving forward. The one thing I will caution, though, in a conversation that I'm having constantly with investors right now is if that's a relatively constructive outlook, then I'll just wait till after the election. I'm not going to do much. I'm not going to make much allocation change even into 2025. And that's where I caution investors that after a couple of years of higher than average growth, much higher than expected average, much higher than average equity returns, a year of good returns for both equity and credit might actually feel not as great as it's felt, right? And so there is still an impetus, a catalyst for change in allocation that we think is important.